Hi everyone, it's Alex here at Session Capital Research. Welcome to our Inner Cycle Friday webinar. It's currently Friday, the 3rd of February 2023, 5 p.m. Eastern for the benefit of the tape. Okay, today we're going to do some more work together on the Wyckoff cycle. And very specifically, what I wanted to talk about is using Wyckoff cycle rotation to manage closed-ended accounts. That's quite a mouthful. Well, I want to explain what that is, if it's unclear, and go on to talk about some theoretical methods and some worked examples as well. The origin of this for me is that this might be a standard thing to do. I don't know. This is something that I come up with my own machinations, but is a sort of a frustration with the buy and hold mentality, really, which I'll explain, and also a function of the way I run my own retirement account. But running it in this way, I found to be very productive, and wanted to share the method, which can be used for your own personal money or institutional money or whatever you care to do. So we're going to run through usual disclaimer, talk about what a closed-ended account is, revisit the Wyckoff cycle itself, look at baby steps, colored crayon simplified examples, and look at a couple of worked examples as well. And as always, we run this on an open mic basis, so if you have any questions, points, objections, comments, criticisms, anything, just shout. Everyone is unmuted my side. Let me just check. Yep. And so all you need to do is make sure that you unmute your microphone and just shout into the system. If you don't have audio or you prefer not to use it, you can use the chat box in the webinar system, or you can post a question in the webinar system, or if you prefer to keep it away from all that, you can always send me an email after the fact. Okay, so let's do our disclaimer first. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or a solicitation of an offer to buy any securities. Nothing in this webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Session Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analysis, or probabilities expressed in this webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Session Capital Research. Session Capital Research values both its independence and transparency and does not believe that this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so back to the agenda just for those who just joined. So again, we're going to run through what a closed-ended account is, what the Wyckoff cycle is, simplified examples, and a couple of real-world worked examples. Okay. So first of all, what is a closed-ended account? Well, a closed-ended account, some of you, this will be familiar to you, some of it won't. A closed-ended account is, in short, an account or a fund where new cash is not being added. So these are, common in some circles, not in others. But if you're a relatively young person and you have a trading account or just a regular brokerage account in which you hold stocks and ETFs, or you have a retirement account in one form or another to which you're contributing, then you might think of that as an open-ended account. So it has, no particular limits on how much cash it can hold. It has no particular limits on when that cash might be added. And if this is a fund, then you might be taking capital contributions from new investors all the time, or you might be taking capital contributions from your existing investors who are putting more money to work with you. So open-ended means you can keep adding money into the pot, basically. Closed-ended means that once the fund or the account is formed, you can't or don't want to add new money to the pot. And there's many reasons why that might be. I'll just walk you through some examples here. So institutional funds, and you see a number of these sorts of funds in institutional management. Very often you'll see it in private fund situations. So real estate funds, for instance, leverage buyout funds, venture capital funds, they typically are closed-ended funds. Once the fund is formed, usually, and simplifying, nothing is absolute, but simplifying, usually it's a pool of capital that is not subsequently added to. And with institutional public equity funds, hedge funds, you may see this as a method by which funds close their doors to new investors and close it to new capital from existing investors. And there's a couple of reasons to do that. Number one, it sort of a marketing reason, really, it creates the actuality or the illusion of scarcity. And so that's always a way to make something more attractive to new investors, which is you can't get in. Don't worry, you can get into our next fund. We're going to raise that next year. You can't get into this fund. So it's a great marketing technique that many managers use. It may also be by design to limit fund size. The larger the fund that you manage, usually the worse the returns are going to be and the more difficult it is to manage the fund. And the reason for that is simply there's a law of large numbers. If you'll see Warren Buffett say this, you'll see him saying, well, to move any meaningful amount of capital, I have to buy either whole large companies or significant stakes in large companies. And if I'm not very careful, that moves the price materially. And also, it's not like I can go YOLOing zero DTE options. I have to buy on the longer term. And so, I just can't make the sort of returns that it's possible to do with hot money. At a smaller example, if you're managing a fund in the tens or hundreds of billions of dollars, then any position sizes you take are going to be meaningful. And most times you move capital in or out of a particular position, you're going to move the market, and you'll try to solve for that by breaking the order up through multiple prime brokers. You'll spend time managing your way in and out of this position. We'll come on to this. It's very relevant to this Wyckoff cycle motif, but it's hard work. Now, the great thing about big funds is big management fees. Obviously, assets under management is a wonderful thing if you're an asset manager. But the trouble with big funds is fund performance, which generally speaking, is a very, very simple statement, is usually worse than small funds because you don't have the agility. So fund managers, particularly if they're new in their life, will often keep a fund relatively small in order to achieve maximum performance. One, because they'll have managers will have their own capital in. Two, because it will make investors very happy. And three, because it will set up a nice early track record for future fundraising. So that's institutional funds. Client accounts. So for those of you who are registered investment advisors here, many of you will have clients who have retirement accounts that are no longer funded with cash contributions, either from the employer or from themselves, the employee or former employee. But they will not be planning to retire and take cash the fund out anytime soon. They may just have stopped contributing to it, and their employer may have just stopped contributing to it for many reasons, of course. Maybe they switched job and this is a legacy fund. Maybe personal circumstances have changed and they can no longer contribute capital to it, many, many reasons. But you will see these accounts in existence, and what I'm thinking about here is not accounts where you need to turn those into cash next year, in which case probably you're not going to do too much with it other than hold it in very stable, secure treasury bonds or cash or something like that. But funds where you have the time to liquidity, where you can take some risk, and where you have clients who are prepared to have you take some risk within reason, of course. Third kind, family offices. And what I mean by this really is larger family offices. And typically this will be hedge fund managers who have stopped managing third-party capital. That could be for good or bad reasons. Sometimes it's for a bad reason, which is it didn't go very well, or a regulator said you've been up to no good and you've been stopped from managing third-party capital. But very often it's because things have gone very, very well. The manager's made a wall of cash and doesn't need outside investors and can just manage their own and their family's money. And very often you'll see these things run on a closed-ended basis because they're not dependent on fishing money out of their salaries or dividends to put back into the fund. They treat the fund as a machine that generates money that can be deployed elsewhere. And that machine is a flywheel that ought to be able to be kept turning by itself. And finally, your own money. So for me, I run personally my retirement account on this basis, which is I have a sort of a forced discipline account where if the balance is going up, it's only because the investing was successful. It's not because I bundled a bunch of new money into it in order to paper over the cracks or average down or any of those things. So and the reason for that for me is very simple, which is I don't plan on retiring for 20 years, and it's very tax disadvantaged for me personally to put capital to work in that account, which I then can't easily access for a couple of decades. So for me, it's illogical to put cash into that. To me, it's makes more sense to run it as a closed-ended account, and it's that situation that led me to figure this model, which is there are many models by which you can manage a fund like this, but this works for me. And I think it's generally applicable to closed-ended funds, and frankly, generally applicable to brokerage accounts, which you believe should be working for you, not be a sort of pit of money into which you throw cash to solve for prior errors. So that's what I mean by a closed-ended account. There are many other kinds, but those are some instances. Okay, so we're going to talk about a sort of a tricksy, difficult to manage, pain in the backside, messing about way to manage money in these accounts. And so a reasonable question might be, why not just buy and hold, right? Why not just find that great stock that's it's a security of a fantastic long-run growth business that's trading at a low that you can just buy some of and hold forever? Well, it depends what you're trying to achieve. So the whole buy and hold religion, the notion that buy and hold is good and has a sort of moral high ground aspect to it, and anyone that does anything different is just some kind of gambler, and a degenerate, is just not true. It's not a true thing. It's just a narrative that's been invented by asset managers. So the primary narrator here is none other than Buffett himself, right? So Buffett, his job is to manage assets, and so what's in his interest is that he collects as many assets as possible upon which to charge fees. And in his case, the method has always been the more assets I have, the more float I have, the more float I have, the more investments I can make, the more capital gains I can make, the bigger my assets under management are. Rinse and repeat. And obviously he's been pretty good at that. But so it depends on what you're trying to achieve. For those of you here that are asset managers, buy and hold is a perfectly reasonable business model. You have willing clients who want you to do that because they believe it to be a sound long-term method. It very often has tax advantages too. And it's a good business model as an asset manager. It's a great way to maximize assets under management. It's a great way to build your managed capital base, which is good for management fees. It's good for marketing. Nothing wrong with it. And again, you'll have willing clients. But if the goal is to manage investment returns in order not to collect particularly management fees, but to collect gains in the shape of performance fees if you're managing third-party capital, or gains for yourself if it's your own capital, then to me, buy and hold is overly simple. Not least because, we all have a problem with our psychology, which is it's very difficult for us to go, well, this is a fantastic buy now, even though the stock is destroyed. Everyone's worried about the economy. Everyone's worried about rate rises or war or whatever the prevailing thing might be that it's said to be causing stocks to be depressed. Very few amongst us have the emotional wherewithal to commit, and also the level-headedness in those times to truly select a great stock. Some of us do, and some of us can do it more often than others, but it's difficult. And if it wasn't difficult, everybody could do it, and investing would be easy. And it isn't easy. It's really hard. It's hard partly because of itself, and it's hard mostly because it messes with your head, and it makes it very difficult to do this buy and hold thing. The other thing is for how long should you buy and hold? It's really easy in retrospect to say, well, it would have been a great idea to buy Apple just when the iPhone was invented. Well, would it? I mean, yeah, in retrospect, sure, but would you have known that at the time? Probably not. and most people didn't. And for those who did, most people have sold their stock by now because the returns got to be so large, people get to worry about them. So the sort of buy and hold forever thing is a thing that people like to trot out as something that is morally good, that is the best way to make money, all of those things. And sometimes it is, but it is by no means a default method, and it's by no means even the best method, in my opinion. Very roughly, I would think of it like this. Buy and hold is primarily of benefit to the asset manager. So if you are an asset manager, then very often, to your long-term clients, you'll be promulgating the benefits of this. If you are an investor, then this is the message you're hearing, and often it's what your brain wants to hear, but it's not necessarily the best thing to do with your capital. To my mind, Wyckoff rotation best benefits the investor, because you're not saying, I'm not going to hold stocks for a long period of time. You're also not saying, I'm going to flit in and out of them and just have lots of transaction fees and emotional stress. And you're also not saying, I'm only going to own Apple for a year or 3 years or 5 years, and I'm never going to touch it again. In fact, it's the opposite of that. Wyckoff rotation is a way to try to, in essence, follow large money accounts around and take advantage of the cyclical, and if not quite sinusoidal, then certainly rhythmic nature with which funds go up, stocks go up, I should say, and then down. Okay, let's move on. Okay, so what is Wyckoff rotation? Well, the theory, this is an idealized, motif, if you like, and the notion here is that stocks move in roughly this sort of formation, and by stocks, Wyckoff didn't mean any stock. He didn't mean this week's hot gizmo. He didn't mean AT&T preferred that barely moves. He meant things like, in today's world, Microsoft, Apple, Procter & Gamble, Pfizer, large liquid stocks that don't have too many scary moments. They don't have too many existential threats. They can be relied upon to move up and down with the weather. In today's world, index ETFs look a lot like this. The QQQ, the SPY, the Dow, the DIA. Index ETFs work quite well like this. And the motif is really simple. The notion is that this is how, if you are a large account player, let's imagine you are a fund managing, several $100 billion of capital, and let's imagine that you're trying to make money from the Nasdaq, just the Nasdaq, and let's imagine that, as will be the case, anything you do in any volume is going to move the market against you. So this is roughly how you would do it. In the accumulate phase, this would be something like right now, actually, early 2023, when there's been a big sell-off in the asset you're trying to acquire, when prevailing sentiment is pretty negative, when the market participants at large, certainly retail participants, are expecting something bad to happen still, and pretty much nobody wants to buy the asset you're interested in. And you would enter this accumulation phase. And accumulate means something very specific. It means buy very carefully over a long period of time, and you'll see institutions do this over weeks, months, years sometimes. Accumulate slowly, and if the stock starts moving up because someone's onto you and can see you accumulating it, or else other people are playing the same game, then with a large account, you can keep the stock in bounds by just trimming some, just selling some when it gets to the top of your preferred price range. When it falls to the bottom, buy a little bit more, and carry on doing this in a very boring fashion. It's the exact opposite of YOLO trading. The exact opposite of zero DTE trading is incredibly boring. If the Nasdaq's down a couple of points, buy a little tiny bit that day. If it's up 5 points, maybe you sell a little bit that day. But you accumulate, you build up a position over a period of weeks and months. And again, you can see this over years, and we'll see a worked example of that in a moment. In this idealized form, what at some point will happen is the story will break, and late buyers, folks who are late to the party, will see that you, the wise one, have been quietly building this thing up. They will know you to be a smart investor because your 30 years in existence tells them you're a smart investor. And the stock will enter a so-called markup phase. Now it's called markup because you finished buying. At this point, you have the stock in your accounts. Your various client accounts are nicely funded with this. You've probably bought some for your own personal account. You are good to go here. When late buyers come in, you'll see two kinds of late buyer. The first kind is a good kind. It's a levered hedge fund who will chase momentum. And so they will be borrowing money from their prime broker to run a levered fund, and they will be chasing stocks up, and their method is buy high and sell higher. It's a perfectly good method. Sounds silly, but it isn't. They're just trying to play with the trend, enter as the trend has already started, so it's moving up, and exit before the trend ends. Perfectly good way to make money if you're good at it. The other form of late buyer will be retail, most retail. And so in this sort of idealized chart here, you could think about levered hedge funds buying early in this markup phase, and retail will buy late in the markup phase, and they may even buy in the next phase. We'll talk about in a moment, the distribution phase. So in this market phase, what's happening is that the stock that's in your account is just going up in value. You're not doing anything. You've already done your work, and now the rest of the market is caught on and is bidding it up. And you can see this just start to happen right now in the NASDAQ, for instance. So look at what happened this week. The NASDAQ woke up this week and it started to move up a lot. Why? Because the penny finally dropped that there probably isn't going to be a big recession in the US, that probably rates aren't going to keep hiking to the moon, that probably inflation is under control, and that probably the consumer is going to keep spending, as evidenced by the GDP number and the jobs data. And as a result, it looks like it might be risk on. While institutions, I can tell you for a fact, have been accumulating the NASDAQ for some months. We will see that in a chart later on. What you now have is late buyers. You have momentum funds starting to come in, and you don't really have retail yet by the looks of it, bits and pieces, but you don't yet see that crazy FOMO that we had through late 2020 and 21. That will come, but it's not here yet. We then move into the distribute cycle. Now, this is the difference between buy and hold and Wyckoff rotation. So in Wyckoff rotation, you know you're going to sell the stock. Okay, so let's take this to be, the NASDAQ for the sake of argument. So let's say right now you're in accumulation phase. Let's say that by, I don't know, the middle of 23, you finish buying, funds and retail get, all balled up and excited. The NASDAQ gets bid up to 500 on the Qs. And then you think, at 550 or something like that, you think, I'm done here. I've been buying in the low 300s and we're now in the 500s. And it's only been a couple of years and I'm done. Well done me. What you'll then start to do is distribute. And that means sell, but it means sell in the same way that accumulate means buy. So distribution, and again, think of yourself here as a very large account player. You can't just dump the stock on the market because the market will plummet. You have to drip, drip, drip it out. Now, what does that mean? So you're in the distribution phase. Your analysis has told you that the market is likely at a high at this level, and you've done that analysis using, very often you'll see that Fibonacci and wave analysis suits this cycle perfectly. We can look at that later on subsequent sessions. So your analysis will say, well, we're a major extension of the market here. This looks like a top. I think I'm going to distribute. And again, you'll do this over weeks, months, sometimes years, usually a bit faster than that looking at it. And who are you selling to? You're selling to people who think that they're buying the dip. They're not buying the dip, they're buying the top, but they think they're buying the dip. So that will be retail, it'll be badly managed funds. You are selling to people who are less good at stock market operations than you are. Basically, that's what you're always looking for. You're looking to buy from people who are less good stock market operators than you, and you're looking to sell to people who are less good market operators than you. So in the distribution phase, Nasdaq's up a few points that day, you'll sell some. If it starts to go down, because again, somebody's onto you, you might buy some. So you might be constantly just trimming your position, but over the course of weeks and months, you've been running that balance down until such time as you've run down your balance either to zero or to the level that you wanted to, and the number of buyers then starts to evaporate because lots of people have been buying this apparent dip, this great opportunity while the market's flattened off. But then as it starts to move down, you'll find very few buyers. And in fact, people will start to sell. And the more people that start to sell, the more people will sell, as we know. And the stock will enter this mark down cycle. Now, hopefully there shouldn't be any marking down to do because you should have finished selling. But we'll call this the markdown phase. And then at some point we'll level off and the cycle begins again in this accumulation cycle. So this is Wyckoff rotation: accumulation, markup, distribute, mark down. Okay, and this is obviously a highly scientific version that I've scribbled on the page here, but you'll be surprised at how often you can see this. This here is the Russell 2000 ETF, the IWM. Hopefully you can see this quite well. This is how, if you're a large account player, you can create returns from nowhere. The grey bars on the right-hand side of this chart are really important. This is called a volume by price analysis, or volume profile. What this looks at is the volume of shares traded for each given price band. And if you use this tool, you can see accumulation and markup and distribution in action. Accumulation and distribution, will be heavy volume because you've got large account players buying up shares or selling shares. Markup and markdown, will be low volume because you have late money buyers coming in, and if they're momentum funds, they'll be in and out quickly, but with relatively small amounts of capital. Remember, your Buffett type funds aren't fast money funds. They tend to be smaller funds. And obviously retail will barely make a dent on these volumes. Distribution, again, relatively high volume up here, markdown, relatively little volume because again, there are no buyers. So this is an actual chart of the IWM from 2017 through to January 21. This is this first green box. This is the accumulation phase. How do you know it's accumulation? Look at the volumes on the right-hand side. And so this green box here, this left-hand green box, tallies exactly with the top end of this so-called high volume node on the volume profile and the bottom end of the high volume node there. And you can see what happens when COVID hits, right? This is the COVID crisis lows into 2020. Volume just isn't there. And that's because institutions aren't panicking, okay? Hardly anyone is selling down here. Who sold here? Retail sold here. Momentum funds sold here, but large accounts did not sell. If they had sold down here, you'd see it in the volume profile, and they didn't. So this was an accumulation phase throughout here, and large accounts just ignored this. And the reason they ignored it is they knew what would happen, which is there would be federal stimulus. And the reason they knew that would happen is because that's their job. If you are a large account fund manager, you spend all your time in DC and with the EU trying to work out what will be the policy framework, what will the monetary policy framework be, what will the fiscal policy framework be, and that drives your decisions the whole time. That is a large part of your job. That's not manipulation, that's just your job. So COVID comes and goes, the deep crisis, the accumulation finishes here, and you can see the markup rocket. So as we know what happened, federal stimulus comes in, free money, and people start buying stocks. But big account players aren't buying it. Look at the volume. Volume's low in this cycle. The IWM runs up, and during this phase here, this is between January 20, this is basically all of 2021 here. And if you go on the internet, go on into it, you'll see extensive debate about whether this is an accumulation or a distribution phase. Well, if you've done your wave and Fibonacci analysis, you would know that this is a big extension of this move up, So if you track back to the 15 low, you will see this to be a natural top, a natural extension of that move up to the 2019 highs. And so you would know that's probably distribution. And if you looked at the volume being traded here, you would conclude that's probably distribution. And look what happens. So it comes to the end of 21, markdown, right? The thing drops like a stone, very low volumes indeed, until we start to get down to this green box again here. And the IWM has been in an accumulation cycle now, so an accumulation element for some months. I think you could argue probably since at least June, July 22. And were we to start the clock at this all-time high, you would see that the volume would be peaking around this this box here. Let's try and show that for a second. Hold on, I'm just going to switch to a live chart. 1 second. Okay, let's get the IWM up. I appreciate all this is rather slow and boring, by the way, but it is a really good method and it's worth spending time on. Okay, so this is the IWM. This is the accumulation, distribution, accumulation again. I'm just going to slide the time start. Okay, so this is your volume profile here. This is when we start the clock in at the end of 2016. So big volumes here in this box, buying, big volumes here in this box, selling. And then if we start the clock at the all-time high at the end of 21, there you go. You can see the volume start to pick up here. Now I haven't done the overlay, but you see where this volume spikes here, right here. What you'll see is that's a Fibonacci level that someone thought was going to hold as a support level. It didn't, clearly, but somebody thought it was going to. But the real volume, you can see it being accumulated right here. So from around, yeah, funny, look at that, from around April 22, it's been accumulated in this zone. It's quite a wide zone if you see, so we've got $190 on the top down to 170, maybe $160 on the bottom. That's a wide area, but this has been the accumulation zone. And what you would expect to see next is, as markets recover, you know, if you look, I'm just going to switch that volume profile off so we can see it. As markets recover, look at this. This is a weekly chart. Look at this weekly candle here, right? So we've shot right out of that accumulation zone. That's this week. We'll probably pull back again, I imagine, before we move up, but pretty soon this thing's going to be moving up. And all these folks who are buying here, these big volume buyers here, they're just going to be sitting tight, waiting for these late buyers to bid the stock up. Okay, I'm just going to go back to the presentation here. Okay, so this is this idealized form that I talked about a moment ago isn't, you know, a flight of fancy. It's not, you know, something that's talked about in, you know, college classes. It actually is how the market works. And the way to use this cycle is because most stock market operators don't have the capital to do this, you know, to move these markets by themselves. But if you can learn to spot how large account players are doing this, you can trail just a little bit behind them and ape the behavior. Now, of course, you won't know the exact day they're buying and selling, but you can kind of work it out at a distance without too much of a lag. Certainly with so little a lag that you can pretty much play the same game. I'm going to go on to a work example in a moment, but before I do that, does anyone have any points or questions they want to raise? Now's a good time to do it. So again, everyone's mic is open, so any questions or points at all, just unmute yourself and chat. I assume everyone is now fast asleep on a Friday having to listen to this boring stuff. Ron, you have your hand up. I'm going to unmute you. Okay, I've unmuted you. Try now.
Okay, I think you can hear me, right?
I can. Yeah, you're on. Hi.
I just wanted to comment on your statement that this is slow and boring. And I want to say not at all. I think it's really fascinating. I've never heard anyone even mention this before.
That's because it's a dirty secret.
Yeah, let alone, talk about it in this kind of detail. And you even said this is the way the market works.
You can see
So,
it. You can see it, right?
yeah,
I mean,
it's not
it's
slow and boring.
okay. I mean, it's obviously an idealized form, but you can actually see it. It's kind of how the market has to work, because if you are managing, hundreds of billions of dollars, how else can you make money? What, you're going to sit around and hope that some stock goes up and you're going to buy a bit and sell a bit? You can't. The weight of capital you have doesn't let you do that. You have to be able to move markets by yourself. And people scream about this being manipulation. It's nonsense. Like, this is what the market is. The market is there for skilled people to take money off of unskilled people. That's what the market is. It's not a weighing machine. It's not a charity. It's not a way for to quietly make money without doing any work. It's a method for people to steal money off less successful people. That's it. And this is how to do it perfectly legitimately. But these tools mean you can see it at work, and again, you can ape it. So to me, it's the thing about this method is it's not exciting to do. In fact, it's very boring to do. And if you're doing it properly, it's really, really dull. And you have to kind of like dull, right? So I personally like dull. I'm quite a boring person. I don't have many outside interests. I actually I can talk about stocks literally all day, every day. Weekends of disappointment because I can't talk about stocks. This is, what I like to do. So I don't find this boring. But you have to like boring. You have to sort of be amused by the art with which people make money from the market. And it has to be a genuine sort of fascination as to how can you get good at this. It's not, zero DTE options trading. It's not, I'm going to YOLO Apple earnings and see what happens. And so most people, frankly, won't do this because it isn't exciting enough. And so if dopamine is the reason that people play in the market, they're never going to do this, because this is like a dopamine free zone, apart from when you look at your account balance at the end of the quarter, right? So this suits me. This suits my approach, and it is great for long-term accounts. There's plenty of methods for short-term accounts. We run loads of short-term ideas in our various services, but for long-term accounts, this is great. And in particular, for me, it solves that problem of when to sell. And this is how I came to it, which is, okay, well, I mean, I can spot a great company at a million miles. That's my whole institutional training, was how to do that. So it's not hard for me to do that. And I can work out a cheap valuation and all the rest of it. But the thing I never could work out until I sort of penny dropped on this was, well, when do you sell, right? Never? Well, what does that mean? Well, what if I die tomorrow? I never took the money out. What if there's a sustained market crash for 5 years? Do I just hold? What? And this was the answer to me, which is, it's a way to cycle time your buys and sells. You can still think that, well, the company whose stock I'm selling and distributing is a great company, and I do want to own the stock again, and I'm going to own the stock again, but not now. I'm going to distribute it now. I'm going to wait, and then when it's back on the floor again in a month, a year, 5 years, 10 years, then I'm going to start to accumulate again. So, but you have to like boring.
Yeah. Boring looks pretty good right now.
Well, it's boring is how to make money, right?
Yeah. All right. Thanks, Alex.
Welcome. Anyone else got anything else before we move on? I'm going to work through a couple of worked examples, which are actually real things. Okay, right. Let's go. So I'm going to work through 2 stocks here. If you read our stuff, you'll know that we use this accumulation markup distribution method in our stock by stock analysis. So, Ron, I'm going to mute you if you don't mind.
Sure.
Okay, you can unmute anytime. And so what you have on the screen here is Iridium, IRDM. This is a fabulous company. The fundamentals of this company is superb. in one of our other services, we started covering it in 2018, I think, if I recall correctly. Iridium is the world's most boring business. It's a satellite telecom business. And the function of the business is really simple. They borrow a boatload of money as cheaply as possible. They use it to pay hardware companies to build a fleet of satellites for them. They pay UPS with rockets, meaning SpaceX or ULA or someone like that, to put the satellites on board a rocket, loft them onto orbit, place them on orbit, and switch them on. You've then got a network working up there, which is used for remote telephone calls. So if you're a remote worker in the Arctic tundra, or you're on a boat in the middle of nowhere, you're running the Antarctic McMurdo station, then you'll use Iridium for your phone calls, because it's basically global coverage. And you'll also use it increasingly for your data coverage as well, relatively low rate data, but you use it for your data work as well. It's the most beautiful and perfect telecom business that there ever was, because all it does is send electrons and radio waves from place to another, and then charges you for it. The business, the stock, as you can see, has been pretty volatile, but it's been very predictably volatile. So in 2017, the stock was on the floor, and that's because the company raised a huge amount of debt, and it had essentially no earnings or cash flow to fund that. It also once, in a very different form, different ownership, been bankrupt, and so the market did not want to know about this, except for clever people who, as you can see from the bottom of this chart, look on the volume profile on the right hand side. There was huge accumulation down at these lows in the sort of single digit prices down there, huge accumulation. So Iridium goes through this accumulation zone in 2017, 2018, and it forms, and it's really important to overlay these waves and Fibonacci extensions of retracements on here, because this is how you can predict when distribution is going to start to happen. Okay, so puts this wave one up here that peaks just before COVID, drops into the COVID low. Interestingly, only drops to the 0.618 retrace of this move up. Most other stocks dropped to the 78.6, so it tells you that the market had already cottoned on here to this being a pretty safe business. The big step up, by the way, in the stock you see here in middle of 2018 is when the first of the new generation of satellites was put on orbit and turned on and was proved to work. COVID lows here, and you then see the stock put in a picture perfect textbook wave 3 high, 1.618 extension of this wave one up. That is a perfect high, and this would be early in 21. And this coincides with some general enthusiasm about space stocks. It then sells off into a wave 4 and troughs, as you can see, at a picture perfect 61.8% retracement of this wave 3 up, and that is also absolutely bang on that wave 1 high. So this is like stock chart 101. If you taught this in stock school, nobody would believe this was a real stock, but this is a real stock. This is what happened. Having hit that wave 4 low, which was early in 22, this is now really important. Look at the timing of the stock's move up. It starts in early 22. Now remember, in 22, the market is moving down fast. Why? Because of rate hikes, monetary policy tightening generally, the Fed rolling assets off its balance sheet, all the stuff we know about. And so, the S&P was down, the NASDAQ was down, the Dow was down, the Russell was down, everything's down, right? Growth stocks hit the deck. But this wasn't. This was in markup. Look. So you'd see an accumulation down here in 2017. If you look at these volumes here, there've been further accumulation coming out of the COVID lows, right? And then you can see as this wave 3 climbs, look at the volumes here, they're almost nothing. You then get to wave 4 retrace, and now if you've been buying down here, what you know this is a wave 5 up. How do you know? Because the Fibonacci retracements and the extensions and the retracements tell you that this is a wave 5, and you know that probably this is going to reach a high and probably it's going to level off, and what's going to happen next probably is a big move down as this combined 5-wave cycle comes to an end and a down cycle begins. So it enters this markup zone, and it hits. And we call, I'm proud to say, we called this pretty much perfectly in one of our other services. We said, you know, sell when it hits the 0.618 extension of wave 1-3 combined, and bang, it did. And you can see it's just hovered around that level now. It's sort of hugged that level. This is in distribution now. You can't see it yet because it's just started. So in our Growth Investor Pro service, we call sell on this. As soon as it hit around this level, we call sell. And so sold early. Now, you know, we can do that because I don't manage hundreds of billions of dollars. You know, some of our subscribers may well do that. I don't. And so, you know, selling quickly into that zone doesn't move the market for, you know, my personal retirement account. But I strongly believe you will see this become a distribution zone here. Why do I think that? It's a fifth wave high. The stock just started to pay a dividend, and that means that there are new buyers coming in, which is income funds that couldn't previously buy the stocks. It didn't pay a dividend. And I believe you'll have sellers who bought down here, you know, 4 or 5 years ago, where they were paying, you know, let's say $10 a share, have now made 5x their money in only 4 or 5 years in a common stock traded on the public markets. Well, that's pretty good. So that's, you know, 30% IRR or something over that period, more probably. So look at the timing of this. This is really important. Okay, so this went into markup through 2022, and as 22 came to an end, it's moved into distribution. Okay, so let's say you held this stock through 22, and at the end of 22, early 23, you said, right, I'm selling. I'm taking my capital out of here, and I'm putting it back in the bank. Okay, so you've gone through a full accumulate, markup, distribution cycle. Next. Here we have, and we don't have, hang on one second, sorry. Sorry, this hasn't pasted in correctly, just 1 second. Bear with me, folks. Okay, here we have Cloudflare. Now, Cloudflare is, as some of you will know, a super high growth, cash negative, you know, scary tech stock. It IPO'd in 2019 from memory, and bumbled along for a while, and then started to really take off once the COVID crisis hit. And the reason it took off then is because the company's original focus was on content acceleration, so basically getting your funny cat videos to you faster. And then it moved into hosting distributed enterprise applications at the edge of the network, which basically gets your corporate applications to work faster, more efficiently with less data transmission costs, all of which is very exciting in the pandemic. And then it puts in a big wave 1 peak right at the end of 21. Huge move up in the stock from $10, $12-ish back in January 2020 up to $225 or thereabouts in the end of 21. It then plummets like a stone and falls back to a level of around 30, if I recall correctly, at the trough here. This stock is now in accumulation. Okay, and look at the timing. Let's go back to Iridium. Okay, Iridium was in markup zone through all of 22, and it's entered the distribution zone in early 23. Cloudflare has been in markdown zone all the way through 22, but just entered the accumulation zone. Let me show you this in a live chart. So let's just switch on the volume by price. So what you're looking at here is these gray bars. Hold on. Okay, so this is Cloudflare live chart. So what you're looking at here is the gray bars on the right hand side. Okay, and And if we start the clock from, what's this, the end of 2019, first of all, look what you can see here. There was a ton of buying down here. And this grey bar here must be over here because the stock hasn't fallen that far in the downslope. So between 13 and around $40 a share back in 2020, there's a ton of buying. You know, there's what, 500, 600, 750 million shares bought in that price zone. Look what happens as the stock moves up. There is no volume up here, right? So from about $90 a share upwards, volume drops off. And from about $130 a share, there's no volume at all. So I can tell you who's buying up here. You know, in this stage here, so between, you know, late 2020 and late 20, so Q3 21, that's momentum funds buying there. That's what that volume is. They're buying and selling and just riding the trend here. But from September 21 up to November, that's retail. Look at the volumes. No one's buying this stock. That's just retail. Now look what happens. I'm going to move the clock to start at the all-time high. Look at the decline. There's no volume. No one big is selling here, right? Because they've already sold. They already sold to momentum funds in this sort of price zone here. Who starts to buy here? Okay, well, once the fund hits and drops below the 0.5 retracement of this move up, folks start to buy. A little bit of volume here. This is not retail. This is probably momentum funds. And what they're doing is they're betting that the 0.5, maybe the 0.618 retrace of this move will hold, right? So there's a band of buying there. Then look what happens. It doesn't hold, right? There's a big drop, oops, and people stop buying because they think it's going to fall, you know, through the floor. Then what happens? It finds support at this 78.6 retrace, and then you see the volume peak. And so from this all-time high here, you can see a wall of buying through this period here. Now look at the timing of this. Okay, so in fact, I bet you, yeah, there you go. Most of the buying, in fact, is from about the middle of the year, 22. In fact, yeah, hang on. Yeah, so from middle of 22 onwards, there's accumulation here is starting to happen. And yeah, I mean, look at the, I know the numbers are gone, but look at the volume here on the right-hand side. A ton of this is as 22 draws to a close and 23 starts. So if in this simple two stock example, you were distributing Iridium in late 22 and early 23, so you were releasing cash from this thing you'd held from back here at, you know, 5 times less your money, and you 5 times your money up here, and you were releasing cash from this. What a fantastic place to be putting it, which is into Cloudflare at this 78.6 retracement that appears to be holding rather well at a time when you know, because you're a big account player and this is your job to know, you know that monetary policy is going to ease, and therefore all other things being equal, equity prices are going to go up across the board. You know that now is a good time to buy. So you're buying, and you're buying with money that you already made, let's say 5 times your money up. Well, I can tell you this right now, if Cloudflare takes off, this is going to be another at least 5 times your money on the way up, if not more. Because when this thing moves, it really, really moves. And the simple chart analysis here using the same method says that the next high will be above the old one. So it might take a couple of years, probably will. But this thing down at $60 a share now, it's just starting to move up. It moved up a lot yesterday. Yesterday, big move up yesterday. This thing can easily go from 60 to 100 to 150 and beyond. You may have to wait a couple of years for that, but that's absolutely possible with this thing. It's a high growth tech stock. They've made noises about losing less money and starting to think about becoming profitable. That will ignite the stock the minute that actually happens. There's every chance this thing runs up. And so in this simple 2 stock example, you've had a piece of capital in Iridium. You've made big money on it slowly. carefully. You've let all the excitement be taken up by everybody else. You've realized it, having enjoyed a markup through a terrible market. You've realized it with growth stocks on the floor. You've released it, and you put that capital back into this growth stock at the floor. And that, in short, is what a repeatable rotation method looks like in a closed-ended account using the Wyckoff cycle. So put very simply, 2 lines here. You can see this is highly scientifically crafted. Your value stock might be under distribution here at the start of the time period. Your growth stock might be under accumulation here. Your value stock will be a markdown, so you're long gone from it here. Growth stock in markup. Now you're not doing anything here. You've already sold. You've already distributed your value stock here. You've accumulated your growth stock using that same piece of capital down here. You're long gone by the time the value stock is getting marked down. You're enjoying the fruits of the markup without having to do anything for it. Your growth stock peaks out here. You distribute. You take that distributed funds, you put it back into accumulation of your value stock down here. You're long gone when the growth stock marks down, and you enjoy the ride back up in your value stock up here, and you distribute up here. You accumulate down here, rinse and repeat. Now, obviously, this is a highly simplified example. Obviously, it's a bit harder than this. Again, if it wasn't, everybody could do it. These opportunities are out there all the time, and all in our service work, all of our long-term investing ideas are focused on spotting this cycle, working out. So take as read, we make a decent job of, is that a good company or not? And we get things wrong, of course, all the time, like anyone. But by and large, we're pretty good at saying, is it a good company or not? Our fundamental assessment is pretty good. So we can have an idea of whether the fundamentals hold up. Then it's about cycle timing of the stock. And obviously what matters to that, monetary policy matters more than anything, probably. The general fashion for what kinds of stocks are getting bought and sold matters, but watching this accumulation, markup, distribution, markdown cycle, that's critical. And so in a speaking personally in my own retirement account, what I'm looking to do the whole time is cycle cash in and out of these opportunities like this. The 2 recent examples, Iridium, I did exactly this, and Maxar, which is another space stock that was just acquired. Maxar was sold, and the sale was announced, I think just before Christmas, if I recall correctly. I sold into the selling the sale news. I made great return on that, and I immediately redeployed the capital into a handful of blown up on the floor growth stocks where I believe the fundamentals are fantastic and that they will recover nicely. So I put some money into Cloudflare from memory. Zscaler was another one, very similar chart to Cloudflare there. So that for me that's my accumulation of capital that I already distributed out of a value stock that was in the distribution zone. Now again, it's not exciting, it's careful, painstaking, boring, but this works. And so the game, if for those of you who subscribe to our Growth Investor Pro service, you'll notice that more and more and more of the growth names we cover are flipping into the markup zone as we've defined it. And so we're moving to hold rating on them. And that's going to be quite boring because, well, hold just means just sit there, right? And just wait. And the reason for that is that probably these growth stocks can move up a lot in the next couple of years, and they'll top out again, as they did in 21. We spotted it in 21, called it pretty accurately. Speaking for myself, I cashed up really well. I bought back in a bit too early on some of those things. There's execution error there, but they're starting to come back into the money now already, so it's not been too painful. And as those growth stocks top out, then it's time to distribute the growth stocks, and by then I would expect value stocks to be pretty much on the floor because everyone will be a big growth bull in a year or two's time because everyone has forgotten that this kind of thing happens, and it'll be time to sell those growth stocks into retail volume, and it'll be time to be buying boring names, Pepsi, Procter and Gamble, McDonald's, Disney, all that stuff. I'm going to show you one chart before we finish up, which is PepsiCo. I don't cover PepsiCo, don't know anything about it, and nothing about consumer stocks whatsoever, no interest in them, nothing. You don't really need it. Here's see. I can't remember. Yeah, here we go. Okay, I'm just going to switch the volume thing off. It makes it a bit easier to see. Okay, so here's PepsiCo right now. PepsiCo, I think, is in distribution right now. It's a NASDAQ stock, which is a bit strange. But here's what it looks like right now. This chart looks exactly like the S&P or Microsoft or the NASDAQ, but all shifted forward a year. So this again is a perfect technical chart. So we have the lows early in 2018 here, a wave one up, peaking February 2020, like some of the other things, a 78.6 retrace into the COVID crisis, standard retrace there. Wave 3 extends to the 1.618 extension of wave 1, picture perfect to the dollar top. And then I was watching this at the time, and it can't push above that 1.618 extension. That's exactly what happened to the S&P back in November, December 21. It's exactly what happened to Microsoft and the NASDAQ at a slightly higher extension, but the same point. It tried and can't push through, and then all of a sudden, bang, sells off again. This is in distribution. We may find it finds support here and hops up a bit, but this is in distribution. This is going to drop, and it'll drop to, you know, maybe 144-ish, 134, maybe, probably 144. Actually, that'd just be above the wave one high here, which would then probably be an opportunity to accumulate once more, to ride the market curve and distribute at the end of here. So you can spot this stuff. Let's switch the volume chart on and see what the volume tells us. Okay, so I'm going to start the clock. Let's move back here. So if we start the clock at the lows here, yeah, okay, so you can see accumulation in this price range here. So a lot of it between 107 and 117 a share. So that will be tracking back to 2017. So over a couple of years here, 18 months, you've got good accumulation going on here. Volume drops off up here. As it moves up into this zone, you get further accumulation. That's after it's just come back up through the COVID crisis. You've got some more buying here, and then volume drops off again. This is a markup phase here. And then if you were to start the clock at the all-time high there, let's see what it tells us. Yeah, look at that. Look at that distribution right there. And what you see there, I think what that is that sellers buying to support the stock around this level so that it can be pushed up and distributed once more. That would be my guess there. So this is PepsiCo. I just pick on it because I was looking at the chart the other day, and it's another, just shines out from a distance. So this I would say is in markdown zone now. So you can use this method for any liquid, well-traded stock. It's not a very good method for niche things with low market cap, low liquidity, not well covered, all that. There's plenty of methods to make money from that type of stock, but this isn't one of them. This is for stocks that large accounts play with. So that's it. That's what I wanted to cover today. Hopefully that's been useful and or interesting, and hopefully folks are still awake. If there's any more questions, points, anything at all, now's a great time. So everyone's unmuted, shout if you have anything, or again, use the chat box here or questions. Okay, everyone is stunned into silence, so we'll call this a day. Thanks everyone for being members of this. This is our newest service, and I'm really happy to say it's the fastest growing service we've ever launched. It's going fantastically well, thank you. Do tell your friends, family, colleagues about it. We're keen to grow the service. It's one that we put a lot of time and effort into. It's a highest quality service by a long way, and for those of you who are members here but not members of our other services, we will always offer you cross discounts across different services. So this pairs particularly well with our Growth Investor Pro service, which is real time. So this is slower, in-depth, more thoughtful, more personal time from myself and the founder at Cestrian. Growth Investor Pro is faster paced, it has actionable calls, permanent set of standing stock ratings, short-term trading ideas, option coverage, macro coverage, blah, blah, blah. So the two services work really well together. If you're a member here and you'd like to sign up for Growth Investor Pro, drop me an email, we'll arrange you a good discount. And we're grateful to the many of you here who are Growth Investor Pro members who are joined over here. So thanks for your time and of course the subscription funds that you spend with us. Okay, folks, thanks everyone. A very successful week on markets this week, and look forward to seeing you all next week. Thanks a lot.